Welcome back. We're expecting a strong opening this morning. Markets looking to open in a high note after a week fixated on trade fears. The Dow declined nearly 200 points yesterday to post an 8th consecutive session of losses, the longest run of daily declines in over a year. Our next guest says a summer sell-off could be on the way. Joining us right now is Stephanie Pomboy. She's the president of MacroMavens. Stephanie, it's good to see you.
Thank you for having me.
Thanks so much for joining us. So you've been worried about the consumer. You've been worried about the broad outlook in terms of the economy.
Right.
You think stocks are going to react?
Yeah, I think so. I think it's overdue. One thing I've been watching is the forward earnings expectations. So on January 1st, the forward earnings estimate for 2019 was 10.8%. At the time, the economy was, hitting all cylinders at the end of last year on the tax cut expectations. And the Citigroup Economic Surprise Index, which is really the ultimate barometer of the tone of the economic data, was 84. 6 months later, the Citigroup Surprise Index is 8, but the forward earnings estimate is unchanged at 10.8%. Nothing has moved in terms of analyst estimates for 2019 earnings, even as the data has disappointed during that stretch.
Well, I'll tell you why, though, right? I mean, earnings season came out and companies came out, they beat, and then they raised guidance higher. So when you have an economic index that isn't anticipating the beat, raise higher, that's the situation. That's why we haven't seen earnings guidance come down, because they've not only matched it, they've increased it for next year.
So two things on the expectations. A lot of that is rooted in, obviously, where people think the economy is going to be in the second half of the year. Second quarter, we're going to see a stronger number. That's going to be temporary for a variety of reasons. Number one is, if you look at May was strong, June's already tailed off. You also have real average hourly earnings, zero growth. So the consumer, in real terms, is not, their capacity to buy is not sustainable here. And then payroll tax receipts. We're looking at these strong prints in payroll employment. They're not borne out by the tax receipt data, which in my view is the last word on what's really happening. Payroll tax receipt growth has slowed. But I think another issue that I'm really looking at is the S&P earnings numbers differ vastly from the government measures of profit growth. In the first quarter, S&P puts earnings growth at 24% year on year. NIPA, the government accounts, which are far broader, capture all U.S. companies rather than just 500 of the largest, was up 0.1%. We've only seen a gap that large between the two of them 3 times before. You'll love these dates. 1987, 1994, going into the soft landing of 95, and 2000. And in every instance, the NIPA numbers were the ones to watch, and the S&P numbers eventually came down to meet those.
But Stephanie, with the larger government numbers on profit growth, that also captures a lot of smaller businesses, right? Who would be just beginning to benefit from the tax cuts?
Well, this is the surprising thing, is that you would have expected that number to be strong, because the small businesses were the ones who were paying the full tax rate. None of the S&P 500 companies were paying, the 35%. They were all figuring ways around it. So it's really surprising, and I think a little troubling to see that the broader measures are that soft.
I think there's a disconnect between you and what's happening in the small cap space, because if we look at the Russell 2000, it's hitting high after high after high, and the Dow's hitting low after low after low. I mean, well, on a 7-day span, you're looking at it. So you're seeing this divergence because the small caps don't have to pay that higher statutory rate anymore, but it's going to trickle in the third quarter, fourth quarter. They're still trying to digest a lot of the tax cuts came through, but it's not instantaneous. I mean, you have to wait for CapEx to roll through. I mean, if you think about 30-day payrolls and you think about everything that has to happen for those numbers to take effect, it's not going to show up in NIPA immediately. You're going to see that in the third and fourth quarter.
Well, we'll see, and we'll see if the increase is really as substantial as the S&P numbers. Again, when you go back in history, we've had tax cuts before where you haven't had this kind of gap between the two measures. Also, I don't look at the markets as the last word on what's happening, because the markets are fallible. Markets were hitting all-time highs, obviously, in 2000 as the economy was going into recession. So, I wouldn't point to the small cap performance as evidence that small businesses are doing much better. It's market expectations that they're going to see the benefit. But the other side of this that really I think is the big story and the biggest risk to the stock market is the credit side. You know, we're seeing now a departure of the stock market from what's happening in the credit markets, where the Fed has been obviously raising rates and tightening credit conditions. They're draining reserves from the banking system, and the capacity to lend is therefore slowing, not surprisingly. So banks, in response, and creditors in general, have lowered their credit standards because they're desperately trying to find new sources of loans.
I asked Sheila Bair about that yesterday.
And credit cards.
And levered loans. Levered loan issuance has been so off the charts that it's now surpassed the junk market. Levered loan market cap is 1.2 trillion. Junk is 1 trillion. I mean, this market is silently mushroomed. And you're seeing, obviously, a massive lowering of credit standards. 75% of levered loan issuance now is covenant light, versus 17% back in 2007 during the heyday.
It's been covenant light, though, since 2014. So I've seen these headlines. I mean, the levered loan market, this isn't anything new when they went back to covenant, light covenants. And the situation is it's on a corporate, this is on the corporate side, right? And if you look at the shocks to the system, it shouldn't reverberate to be what it was in 2007, because that was more of a real economy. This is more in you're talking about leveraged loans through the financial markets. And so it's hard to see should there be distress in levered loans, it shouldn't have a knock-on effect and drag down the world economy.
I'm just using that as an example of the credit market in general, and I do think the credit market in general, you're seeing a tightening of credit conditions, as you would with the Fed taking back its monetary accommodation. You're seeing a degradation of loan standards, and it's coming at a time when the corporate sector has to roll $1 trillion of debt this year as rates and spreads are widening out. That's going to catch people, whether it's in the levered loan market or other weak links in the credit chain. I'm just highlighting the degradation of lending standards and corporate balance sheets.
Always watch credit, because you talk about history. If you go back to the financial crisis of 2008, it was in 2007 the credit markets and the bond markets had fallen apart. Those Bear Stearns hedge funds had already blown up, and the stock market kept going up. The Dow hit a record in October of that year, and the entire home loan market was just in peril.
This is why I'm thinking this summer could be like summer 2007, when that sleepy corner of the asset-backed commercial paper market was starting to fall apart, and the dominoes started to be knocked over, and eventually it did catch up to stocks. But credit always leads, and you're seeing a real tightening of conditions there, and we've got a lot of debt that still has to roll.
How significant a sell-off are you expecting in stocks?
Substantial. You know, we had talked about 30%.
30%.
I think given the valuation extremes that we're at right now, that could be easy.
All right, we'll leave it there. Stephanie, it's good to see you.
Happy summer.
With this news, Stephanie Pomboy, always great to get your insights, Stephanie. Thank you.